Well, folks, we're getting through it. We're halfway through the week. We still have a lot of earnings reports to go, but so far we've already had a few really important earnings reports, specifically Visa and Tesla. These are two companies that are very different, but I'm going to be going over both of their earnings reports today. And we'll also be looking at the financials in a visual perspective. Using Qualtrim, this is a website that's included as part of the Patreon. This allows us to see what happened visually with the companies so we can get some context into what their fundamentals look like. And of course, we're going to be looking at this with both of these companies. But not only that, we also have different aspects of these companies I want to look at. For example, the transcripts. A lot was said on these earnings reports, and there's parts of it that I think is worth highlighting. Elon Musk had a lot to say in this earnings report call. He had a lot to go over, a lot of ambitious things to say, and a lot of people may have not listened, but the Visa CEO had a lot to say this earnings report. In the transcript we're going to go over, I'm going to highlight some parts of where the Visa CEO sees the enormous opportunity for their company. From his perspective, Visa's really just getting started, and it's really incredible to see. So this is going to be a busy one. We have both Visa and Tesla, both what happened this most recent quarter, and what they say is going to happen in the future. And as always, I'll give you my thoughts and perspective as well. Now, before jumping into this, I think it would be fun to look at what I predicted earlier this week. On Monday, I came out with a video here where I went over every important earnings report coming up this week, and I had some predictions on both Tesla and Visa. This is what I had to say about Visa. The nice thing about being a Visa or MasterCard shareholder is you go into earnings season without really any anxiety. There's no concerns going into earnings season. You know, it's typically going to be business as usual. These companies almost always hit their earnings metrics. They do so well with earnings. There's a chance they can come in slightly below, but it's usually a slight miss. So Visa is not one that I'm concerned about at all. I think if you're a shareholder going into Tuesday, I just don't think you're concerned about this at all. Now, if we bring up the report here, Visa did post both beats on the bottom line and the top line. The earnings report overall, I thought was fantastic. If we look at a couple summaries here, we can look at what they highlight at the top here. We have the net revenue of the company, $8.8 billion, or a 10% increase year over year. Now, if we look at this visualized, we can go right here to this revenue chart. And let's just take a look at it over the longer history. We have the last quarter right here, $8.78 billion. And that is, of course, the 10% increase year over year. So we go from right here to right here. A nice, healthy increase in revenue. This company still is growing 10% per year in its top line. And look how big this company is. Look how long it's already been alive. This is a fast-growing, large established company. And it's a theme that I've seen repeated over and over again. Big companies, ones like Microsoft, ones like Amazon, ones like Visa, continue to grow like they're small startups. It's really incredible to see. Other smaller companies may actually have more difficult time growing than Visa. So we see a lot of top-line growth here. Now, we can go back to the earnings report. We look at a couple different metrics here. This can get confusing of what to use. They have their non-GAAP earnings per share, and then they have the non-GAAP net income. Non-GAAP meaning that they can really change these metrics to be whatever they want. So you have to look at the adjustments. Now, in most cases, I believe the adjustments that Visa makes are actually reasonable. They just take out some one-time expenses to make the earnings a little bit more smooth. But we can also just look at the GAAP earnings per share. GAAP means that it's based on generally accepted accounting principles. This came in at $2.29, or a 12% increase year over year. On the non-GAAP earnings per share, this is what most analysts are using for Visa, and this came in with a 20% increase. The non-GAAP net income came in with a 17% increase. Imagine how fast this is. Really consider how fast of growth this is. They're growing at the speed that Google has been able to grow for the past decade. It's really incredible to observe a company this big, this established, growing their earnings per share at 17 to 20%. Now, there's some other KPIs they give. Payment volume grew 8%, cross-border volume grew 16%, processed transactions 11%. Everything is growing everywhere for Visa, and there's a lot of secular trends that are making this possible. So we'll go into those a little bit later. Now, a lot of people value companies different ways. Some of them value companies based off of price to innovation, what's going to be innovated and disrupted in the future. The way that I value companies is based on cash flows. realistic, grounded assumptions of current and future cash flows. When I look at the statement of cash flow here, they do something a little bit tricky here. They break it out in the past 6 months, and I just want to see the past quarter. So these numbers are the past 2 quarters. That's not really what I want to see. Luckily for us, Qualtrim already breaks this out. We go down to the free cash flow chart, and the previous quarter was $4.91 billion, which is a 35% increase, 34.5 over the prior year. So from here, this quarter right there to there, that is a 35% increase in free cash flow. And they're also doing buybacks during this time period. It's really a beautiful thing to see. There's lots of beauties in the world. There's the sun setting in Hawaii. There's Roman cathedrals. There's looking down views on mountain peaks. And then there's Visa's free cash flow. All these different beauties that we can see in this world. But truly, this is just a sight to see. There's not many companies that can grow their cash flow this fast for this long. And they're doing it again quarter by quarter. A lot of people think it has to end at some point, right? Visa's so big and there's so many credit cards. This has to end and Visa's cash flows have to go down. But that's a misunderstanding of the secular trends that are driving this company. And they talked about those secular trends and the execution in the earnings transcript. If we bring up the transcript here and we go to the most recent quarter, there's one part of this I want to highlight. It's where the CEO of Visa lays out his plan for the future. So you can see it right here. This in green is the Visa CEO talking. He says that there's multiple parts of their strategy, primarily 3 parts, but let's start off with consumer payments. This is the biggest part of Visa's strategy. The opportunity in consumer payments is enormous. Based on the latest public data calendar from 2022 and our analysis, we estimate that the total global personal consumption expenditures, or PPCE, excluding Russia and China, was approximately $40 trillion. Within the $40 trillion, our addressable opportunity is more than $20 trillion. This includes 3 components. 1, cash and check, which is about half of the addressable opportunity. Cash and check is half of this $20 trillion opportunity, so around $10 or more trillion. He continues on giving examples of how they're winning over this opportunity. So this isn't something that maybe they can do in the future. No, they are winning over this total addressable market today, right now. Tap to Pay is a great example of how we are converting small ticket cash transactions to Visa credentials. 2, ACH and other electronic transactions. We have many examples in this space, including the work we are doing to extend Visa and bill pay methods in acceptance categories like rent, education, and loan repayments. With the UK growing credentials at its fastest rate since 2016, driven in part by strong growth in fintech clients. In addition, from 2018 to 2023, we converted over 20 million credentials in Europe that primarily ran on domestic networks to Visa. So they converted 20 million credentials from domestic payers over to their network. They're winning over markets that have already been somewhat established. Visa's still winning over different markets. The consumer payments business is the one that most people know about, but they also have net flows and value add services. Both Visa and MasterCard have a huge value add business, and most investors, I feel like, aren't aware of that. So when you read through these transcripts, you get an idea of the scale of the opportunity here for Visa. $40 trillion in payments, and still there's trillions and trillions of dollars worth of payments being done with checks and with cash. Visa and MasterCard's biggest competitors are not each other. It's not PayPal, it's cash. Cash is Visa and MasterCard's biggest competitor. And cash doesn't fight back. It's not an organization, it's not a company. So the opportunity, in my opinion, still remains very large for Visa shareholders. I don't own Visa, but I still look at this company as the opportunity being great. The valuation being very healthy right now. A 27 forward PE and a 3.5% free cash flow yield is completely reasonable. In fact, I still believe good value for this company. The valuation's reasonable and the fundamentals are fantastic. The future outlook and secular trends are still intact. And I don't believe that the government is going to break apart this company or cause destruction, because most economies benefit. They benefit from having Visa and different payment methods that are more digital. So as far as I can tell, this earnings report was great for Visa. I really have almost no criticisms for it. Next up, we have Tesla. Let's go ahead and take a look at what I said about Tesla just a day ago. I am concerned with Tesla this quarter. This year has been tough for the company. The amount of price decreases has also caused concern. So I do not feel confident with Tesla this quarter. And I think that management is likely to try to focus the conversation more on the robotaxi and the future of the company than the current fundamentals of the company. But maybe they can surprise. Elon Musk has done it in the past, so we'll see if he can pull a rabbit out of a hat. And I think that that was mostly correct. Now, Tesla stock went up big after earnings. The stock was up around, I think, 15% at one point. Today, it's up around 10%. So it's come down a little bit, but it's still up big. And this can happen sometimes, especially if a stock has gone through a string of really bad news. Investors have already sold out of it in many cases. And the rest of the investors are bracing. They're bracing for bad news, and it's slightly less bad than what people expect. Or at least there's something to look forward to. And I think that's what Tesla, and specifically Elon Musk, gave Tesla investors. He gave them something to look forward to, something as a North Star for the company. So before we jump into Elon Musk's comments, I first want to just take a look at Tesla's report, take a look at how the company's doing. We can look at the actual earnings report here. This is the financial summary, and they lay out everything really nicely here. When I look at this, it's not great. There's no way to sugarcoat this. Like, this quarter in particular was really bad. So I'm not going to say that this is like a really good quarter. I think even really diehard Tesla fans would admit this wasn't the strongest quarter from Tesla. You look at basically any metric, and most of them show a company that is struggling with demand. Interest rates have gone up. That has a real effect on the ability for consumers to get loans. Consumers are paying a much higher interest rate on borrowing capital. In most cases, you have to borrow capital to buy a car. So total automotive revenues is down 13% year over year. We can look at this visualized here. If we bring up Tesla, we go to the revenue right here. We look at this and it went through its massive growth period from like 2015 to 2021. And that's where it made a lot of millionaires. Tesla made people really rich through this time period. If you invested in it back here, the stock price was dirt cheap, but it's already gone through this massive scaling up growth period. And then since around 2022, the revenues have not gone up. So they went up a little bit, they flattened out for about 5 quarters, and then they went back down. We can look at this zoomed in a little bit. That shows it a bit more clear. Tesla is down in revenue below where it was in, this is September of 2022. So the third quarter of 2022, Tesla is below that in revenue. Now, I don't think this is doomsday for a company. Some people have said the same thing about Apple. Oh no, Apple stopped growing, right? It's a high price company and the revenue was flat for a couple quarters. That in and of itself is not doomsday for a company. Companies are not, in most cases, they're not like Visa. They don't just grow revenue every single quarter of every single year. Those are very unique companies. Most companies and most industries have some cyclicality to them, and especially in the car industry. Tesla still derives 95% of their revenue from selling cars. It is impossible to get rid of cyclicality when 95% of your revenue is selling cars. So if you're invested in this company and you're hoping that revenue goes up continually, you're just going to be disappointed. If you have the expectation that there's going to be some cyclicality, then this can fit fine with your expectations. Now we move on from the total revenue and we go down to the margins of the company, specifically the operating margins. This is the one that I think is the most important for Tesla. Now, just as a refresher course, when we're looking at margins, the gross margins are the price you sell the thing minus the cost of goods to create it. So just the cost of goods. For example, if you sell something for $100 and it costs $20 to make it, you have gross margins of 80%. So Microsoft, for example, sells something for $100 and it costs $30 to make. They have around 70% gross margins. That means the stuff that Microsoft sells is not expensive to make. Overall, it's a very capital light business. They don't have a lot of cost of goods. With Tesla, we look at the gross margins of the business, and of course, it's a car company. It has more expensive costs of goods. So we look at the gross margins, and it's around 17%. Now, when we look at the operating margins, this factors in a few more things. It factors in the operating expenses to run the company, paying employees, manufacturing costs, right? Shipping things around from one place to another. You have all the operational expenses mixed in. So you can have a little bit more leeway with operating margins because you can do things to cut costs here besides just cutting costs of goods. With the operating margins, we saw this decline a little bit quarter over quarter and a lot year over year. So it went down to 5.5%. Now, this was expected. In fact, Tesla was supposed to be around this amount, maybe a little bit less, but it's still not good. It's going in the wrong direction. When we look at this overall, again, we can chart it out here. This is what it looks like. The highs for Tesla were around 19%. That's when they were really selling their vehicles for a lot. Again, it was the ideal time to sell vehicles. And since then, it's been a struggle. Cutting prices, lowering your margins results in lower operating margins. And even though Tesla runs very efficiently, they try to lower their expenses in running the operations of their business, it's still very difficult when they have to lower prices. So we have 5.5% there, which is the lowest it's been since 2020. Now, obviously, investors knew that this was going to happen. Again, they're bracing for this. So they have an expectation it's going to be lower. And I think a lot of investors right now are saying that this is the trough. This is going to be the very bottom of the operating margins. And from here, it will be a steady climb, a steady step upwards from here. So that's a summary of the fundamentals, the financials of this quarter, which for Tesla were not great. And I think any investor will admit that. The thing that Elon Musk needed to do with this quarter is give a light at the end of the tunnel, give something that investors can look forward to. And that's exactly what he did on the call. When we look at the earnings transcript, I want to highlight a few parts here because Elon Musk, he promised a lot of things in this earnings call. We can start off with this introduction here. He says that we've updated our future vehicle lineup to accelerate and launch new models ahead. Previously mentioned startup production in the second half of 2025. So we expect it will be more like early 2025, if not late this year. These new vehicles, including more affordable models, there he mentions the more affordable, the $25,000 Tesla, will use aspects of the next generation platform as well as aspects of our current platforms, and will be able to produce on the same manufacturing lines as our current vehicle lineup. My guess is that Tesla is going to strip down some of their current vehicles, make them a little bit more simple to get the cost down, to get that $25,000 vehicle. So it's not contingent on any new factory or massive new production line. It'll be made on our current production lines much more efficiently. And we think this should allow us to get to over 3 million vehicles of capacity when realizing to the full extent. Regarding full self-driving version 12, which is the pure AI-based self-driving, if you haven't experienced this, I strongly urge you to try it out. He says it's been pushed out, and he thinks that around 1.8 million vehicles, and we're seeing about half of the people use it so far. And that percentage is increasing with every passing week. So far now we have 300 billion miles that have been driven with full self-driving version 12. Our entire road network is designed for biological neural net and eyes, so naturally cameras and digital neural nets are the solution to our current road system. And he doesn't only bring up Amazon, he also mentions Airbnb and Uber. He says, and something I should clarify is that Tesla will be operating the fleet. So you can think of like how Tesla, think of it like some type of combination of Airbnb and Uber, meaning that there will be some number of cars that Tesla owns itself and operates in the fleet. There will be some number of cars, and then there will be a bunch of cars where they're owned by the end user. That end user can add or subtract their car from the fleet whenever they want. And they can decide if they want to only let the car be used by friends and family, or only by 5-star users, or by anyone at any time. They could have the car come back to them and be exclusively theirs. So he's actually outlining like specific functionality, specific strategy of how this autonomous fleet will work. He's getting into the nitty-gritty details of how you can include your Tesla car in the fleet. You can filter by just wanting to accept 5-star passengers. You know, the ideas behind this they're incredible. This would be amazing, right? If Tesla's able to accomplish this, it'd be something amazing. So if you believe Tesla's going to get to full self-driving, they're going to have the robo-taxi fleet, you're now getting a picture painted of how all of this is going to organize and work with the actual specifics of it. So I really like what he's doing here, but this is all stuff down the road. This is on the assumption that they get to level 5 autonomy and get approved to have a massive full self-driving fleet. So there is quite a bit of road to go before they get to that point. Now he continues on with this saying, With a constant feedback loop, every time something goes wrong, that gets added to the training data. And you get this training flywheel that's happening the same way that Google search and has other sorts of flywheels. It's very difficult to compete with Google because people are constantly doing searches and clicking, and Google's getting the feedback loop. So he's comparing the feedback loop of training data with his cars compared to Google, their feedback loop of training their search engines to be better with more queries. It's the same with Tesla, but at a scale that is maybe difficult to comprehend. But ultimately, it will be tens of millions. I think there's also some potential here for an AWS-like element down the road, where if we got very powerful inference because we've got hardware 3 in the cars, but now all the cars are being made with hardware 4 and hardware 5, it's pretty much designed and should be in cars, hopefully towards the end of this year. And there's potential to run, when cars not moving actually run distributed inference. So there's a lot of name dropping going on here. It's like when you're trying to show how popular you are, so you're mentioning different friends or different people that are popular. This is kind of what I feel like Elon Musk's doing here. He first starts off mentioning Airbnb and Uber, two companies that he says it's going to be a combination. The robo-taxi fleet's going to be a combination of how Airbnb and Uber work. Later on, he jumps down to saying the feedback loop is going to be like Google. Google has one of the most amazing flywheel feedback loops ever, with one of the best, if not the best business ever with Google search. So he name drops Google, saying that the flywheel of Tesla is like Google, but on a scale that's even bigger. It's difficult to comprehend. So a massive scale flywheel like Google, and then he drops the biggest name of all, the one that everyone loves to drop, which is Amazon. How many times have other executives and companies and investors compared different companies to Amazon? It happens all the time. It's something that I've talked about repeatedly. Companies will say, and investors will say, that this is the Amazon of South America. This is the Amazon of China. This is the Amazon of Korea. There's always the Amazon of this or that, the AWS of this or that. And here we see Elon Musk doing the same thing. He's compared Tesla to Uber and Airbnb. He's compared it to Google. Now he compares it to AWS, saying that they are potentially going to have an AWS-like moment where they can run computer distributed inference on idle Teslas, where you get the benefits of running all this computer hardware, but with only paying for the electricity, you don't have to pay for the hardware costs. You know, this is, I guess, theoretically, there's some possibility of this happening, but more realistically, I don't think a lot of people understand how unlikely or unrealistic this claim really is. And I think you have to actually work with AWS to understand how this comparison is not something that investors should bet on. It's just not. I have worked directly with Amazon's web services for years. It's something that I worked with in development. I build websites on it. Qualtrim.com is built on AWS. The features that AWS have are not things that you can easily replicate. You can't just spin up a bunch of computers and build what they've already accomplished. Their features are so extensive that if you look through the list of their services, there's hundreds of them, and each of these take years and years to build. AWS has around 30,000 developers working on it. 30,000, and it's massive. The scale that they're working on is massive. Almost every company in the S&P 500 at least uses some part of AWS and has built their business on it. So I understand that Elon Musk isn't saying this is going to be exactly like AWS, but I just want to be careful here that investors reading this don't think, wow, Tesla's going to become the next AWS with their cars. It's very unrealistic to believe that. It could have some similar things. Maybe you could run some computing on it, but you're not going to replicate AWS by trying to spin up a distributed car inference server. That's just not how it works. AWS has an incredible amount of sticky products that have been built on the service, and it takes years to get a customer off of AWS. For example, Netflix, one of AWS's customers, estimated it would take over 2 years if they were to move from AWS to another cloud service provider. Over 2 years for a company that has that good of a technology team. Building upon AWS makes it very, very difficult to leave, and you have to have an incredibly strong incentive to do so. So I like what Elon Musk is doing here. I like that he's painting this big picture. That's what he's supposed to do. He's the CEO of the company. People know this about Elon Musk, and they invest with him because they know he dreams big and he builds big. So I like that he's doing this. I'm not criticizing him for painting a big picture, but I also think that investors should put it into context. Some of these comparisons are very difficult to actually accomplish. Making it so you have an AWS-like moment, having a flywheel like Google, accomplishing what Airbnb and Uber already have with their networks, that's very tall orders. Overall, my conclusion is the same. Tesla's an interesting company. It occupies a lot of media attention, a lot of CNBC attention, a lot of Twitter attention, and attention on YouTube. It's the nature of the game. It is a company that demands a lot of attention. But in my opinion, I still think it's a risky endeavor. A company that does show a lot of cyclicality, that has some big bets that it has to win to make the company a worthwhile investment. And in my opinion, I still think there's better risk-adjusted returns out there. So that's my take on this earnings report. Let me know what you think. See you in the next one.